Welcome back, guys. We have a very special guest here, John from Impact Wealth Solutions. So they're actually our partner in helping our clients with their investment strategies, mainly regarding real estate. So yeah, John, why don't you tell us what are some of the challenges that our clients see that, maybe that you guys can help them with?
So I work for Impact Wealth. We're a financial wealth and management company, and we help them from a holistic standpoint, whether it's investments, real estate, all those type of things. So for real estate, what's interesting is it's a great wealth building tool. You guys know, you guys are realtors. It's such an awesome way to generate wealth. I mean, my family's benefited from it. At some point, it becomes challenging to manage. You guys are familiar. What are some of the challenges we have now? High maintenance fees, right?
Yeah.
What else?
The terrible teas,
right?
Termites.
Yeah.
Trash.
And taxes.
Taxes,
is the biggest one, right?
So at some point when we talk to our clients, we look at their portfolio. Real estate is a good asset in the sense it appreciates, but the cash flow is terrible in many ways. And it's because of, expenses here. And the elderly clients I help, they're just tired of being landlords. They're just like, I got a call from a tenant and they want this and that. And so they ask, what are my options? So as you guys know, they can sell, but what happens when you sell real estate?
Pay taxes.
You gotta pay taxes on it.
Huge, right?
Yep.
There's 4 taxes that they have to pay, right? You have federal capital gains tax, state capital gains tax, then you have this net income investment tax, 3.8, and then depreciation recapture, which is a hidden tax. All those years that they've held real estate, they got the depreciated sheltered income, but when they sell, Uncle Sam says, hey, where's my money? So the government says if you own real estate, you get to depreciate the building. So in Hawaii, let's for example, it's $1 million property, right? If it's assessed at $500,000 the building, $500 the land, you can depreciate the building, not the land.
Okay.
So for residential, the IRS has said 27 and a half years you can depreciate it. So let's take 500,000 is the building.
Wait, the 27 and a half, that's standard, that's what it's set at. It's not
for residential. That's set by the federal government, right?
Why 27 and a half?
They came up with the useful life of the building. That's what they're saying is the
so that's the average life of when
you have to rebuild. Okay.
So for the next 27 and a half years, you can depreciate $18,000. So say your rent is $28,000. You take the $28,000, you minus off the 10,000, and you only pay tax on the 10.
Oh, so that's a pretty good.
That's a great way, right?
Oh.
That's a great. But when you sell, that's when you gotta pay it back.
So you're telling me that after you write off all those taxes and you sell your home, you have to pay all that back to the IRS?
Yes, it's called depreciation recapture, and people don't know that. So we see that as a dilemma for a lot of our, our clients are like, I have this property, it's okay generating, but I don't know what to do with it. So we actually introduced this thing called a 1031 exchange. It's a very generous tax code. What allows people to sell the asset, buy another replacement property. There's rules on that, but they get to defer the gains. They don't pay taxes on that. So they can buy a different property. There's this rule, IRC 1014. So when you pass away, you get to pass on to your heirs a stepped up basis. So say you bought a house in 1984 for $100,000.
Yeah.
Now it's worth 1.1 million. How much gain is that? $1 million, right?
$1 million, yeah.
So when you pass away, your heirs get a $1.1 million. That's their starting point.
Wow.
And
so they can pretty much turn around and sell that asset and not pay any taxes.
Any taxes, yeah.
Oh, that's really powerful.
So those are the tax rules that people don't know. And you hear people like, oh, I'm going to give my kid this property while I'm alive. That's the worst thing you can do. Because they don't get the stepped up basis, right? So knowing that tax law, the 1031 exchange, there's this thing called a swap till you drop, right? Okay, so what you do is you swap your properties, you keep doing it, you keep swapping until you pass away. You drop the drop part of it, and then you pass it on to your children. But that's taking advantage of the tax code to defer the gains till you pass away.